Very good. It's 11 o'clock. So to get going, we've got a bit of news first from me and Richard. Then we're going to be handing over to Andy McHattie, who's going to be talking over what happened during November. And then I'm going to be talking to David Smith from Henderson High Income. So a bit of news from me first. Keystone Positive Change and Golden Prospect. Keystone, we know, disaster. And since they sort of announced things have been going on, their discount's been narrowing in, but it's still about 5.6%. And they've published a circular today to discuss how they're going to manage the end of the life of the trust. So the choice is between 100% cash or a rollover into an OIC, which is very similar to Keystone Positive Change, almost identical portfolios, but obviously it doesn't have any unlisted positions because it's an open-ended fund. And the open-ended fund is the default option. There's a constant message from the board, which is that Keystone would have been great if we'd only given it more time. I think the jury's out on that, but that is the message, and so therefore they are arguing that they want people to roll into the open-ended fund and then reap the rewards when everything comes right again. The costs of doing all this aren't cheap. So it's £812,000, or about 1.37p per share. So that's coming off the NAVs of everybody, whether you're a cash exitor or whether you're an OIC switcher. But the way that it's structured, the cash exit is at a 1% discount to effectively former asset value. And I don't understand that. And actually, I'm quite upset about it. I don't think that is a fair way of approaching this, to be honest. I really think that cash exit should have been the former asset value. So the unlisted things is what complicates everything. They have sold one of them. That's a great help. Norfolk's gone bust, which sort of takes that out of the equation, really. They're still sort of talking as though there might be something recoverable for it, but I think it's instructive that Goldman Sachs has written it off completely. The ones that are left, Climeworks, I'm really not sure about, but there it is there. They think they might be able to sell it, but the whole idea of it is that you set up some big machines in Iceland that actually take carbon dioxide straight out of the atmosphere by filtering it, which is an extremely inefficient process, and then pump it underground where it combines with basalt. It clearly only works for if it encourages enough subsidies and stuff. I mean, there's no economic logic to it at all. PsiQuantum, quantum computing, they are busy building proper utility scale quantum computers. There's definitely one in Australia. I think there's another one in the States. That I think is probably more sellable. And then the other one, which I think is really interesting, is Spiber, which is making man-made fibers from plant ingredients rather than sort of petrochemicals. I'm not sure how the cost competitive that is or not, but that just actually seems like an interesting business. And again, so they might be sellable too. So basically, all of these things get put into the liquidation pool and then get turned into cash over time. And that might take a long time, or it might be done really quickly. We just don't know. The meetings to approve all of this are in January and February. There needs to be two, but you won't be able to deal in the shares after the 27th of January. You're able to trade in the OIC until the 10th of February, and the cash option won't pay out until the 17th. So my inclination would be to switch into the OIC and then immediately cash that in. There's no exit fee on the OIC. But they do adjust it to reflect the outflows, but they're really only doing that to reflect the costs of dealing. So I think that's probably going to be a sort of a fair price, and then you don't lose that extra 1%. But there we go. Golden Prospect, very quickly, really quick on this. It's still tiny, even though after this subscription share thing that's had, the discount's about 23% at the moment, and they see that's been widening out. This all relates to the subscription shares. So these are embedded within the company. They're not a separately traded thing. They give you the right to buy shares in the fund at the previous year's NAV. This time around, the exercise price is 35.94p. And because that was they were in the money, but not very much. So roughly half and half exercised and decided not to. The interesting thing is that because it's only marginal now, because the share price has come down, I think in anticipation of the subscription trustee exercising those 9.4 million rights and then trying to place those shares in the market, because that's not going to happen. I think the share price will now go back up again. So basically, it means that if you took up the rights, and I did, and I think probably sure a few other people did, then you bought these shares at 35.94p, and I think the share price is going up from here. If you didn't take them up, you'll just missed out completely, and you've just been diluted. But there we go. Next year, the rights price is going to be 48p. If we get into a position where people want to exercise that, that's all good news. Right, now I'm going to hand over to Richard.
Thanks, James. Just a quick one from me on home REIT. So shareholders have been given the option to tender their shares at 4p this week, which was quite a surprising move. So Selby Capital, who I've never heard of, but I've looked them up. They specialised in distressed securities and liquid securities. So this is sort of right up their street. So they've offered 4p, which values the whole company at 32 million. They don't want to they want to avoid the mandatory takeover, so we'll limit the acceptances. But they say it offers shareholders, obviously we know the story on this, an opportunity to get out while they can. There's a lot of sort of uncertainty of how much they'll get at the end of this, when that will come because of the sort of litigation, stuff like that. So the offer expires at the end of December, so we've got a bit of time to think about this. So they're currently in a managed wind down. They've been selling off some of the sort of run of their portfolio at auction, and that's come to a close. They've now got a portfolio of about 850 properties, which they are marketing, and they're hoping to get 175 million. Whether they will remains to be seen. And they'll return that capital to shareholders once that's completed. Again, the 850 properties, they'll probably want to sell that all in one batch to someone. That's going to have an impact on the price and things like that, and it's going to take a while. So it's uncertainty on timing on that. But last week, it finally repaid all of its debts to Scottish Widows, who then charged them another 9 million to sort of release its charge over the portfolio, which they will pay through. There's a portfolio that they sold recently at auction, which hasn't completed yet, for about 17, I think it was. So that will pay down that, and they'll have a bit of money left over, which will probably cancel out the estate agent fees that they'll pay on selling the properties. So you can sort of back it out, 175 million. The NAV based on that is about 21p. But then obviously you've got all of this stuff coming up, which will take a lot off of that. So yeah, so they've got shareholder litigation against them, which they're fighting. They're also suing the former manager, and they're facing this FCA investigation. So all that's going to take up a lot of time and money, and they've still not published their up-to-date accounts. So we also had yesterday at their general meeting, shareholders refused to approve the historical accounts from 2022, which means the company now must consult shareholders. I think they've already done that pre all of this. For the reason of rejections, it seems to me to be a protest vote, because it's all sort of a new board and everything like that. I can't see them wanting to oust the new board while this all goes on. So it seems to be a protest vote. But the accounts from 2023 and 2024 are still to come. So they say they're going to report on the accounts for 2023 by the end of this year. So that's in the next couple of weeks. And then the accounts for the to the end of August 24 They hope to publish it by the end of the first quarter next year. So that's when shares will start trading again. And then we'll see where the share price drops to when that happens. On the next slide, James, just a couple of points. Yeah, so and that will also provide the updated NAV, so we can work out exactly how much we think this company's worth. It's going to be more than 4p, so I'm not sure anyone should really take this tender offer. People might just want out and get some money back, and that's probably what the Salvi are sort of hoping for, really. But yeah, I would wait if I was a shareholder until we see more sort of visibility on what the value of the company is, and how this sale process will go.
Oh, thank you. I mean, the really frustrating thing with this is that those accounts were supposed to be all published.
Yeah.
By the end of the summer, by the end of September, and now we're into the first.
Yeah, and they've not really given a reason why.
No, exactly.
So,
no one people vote against. Anyway, let's hand it to Andrew.
Thank you very much indeed. I mean, that is a horrendous situation, and I must say the word that springs to mind for me from that tender offer is opportunistic. But there we are. We'll see if anybody fancies it. I think we probably need a bit of cheering up after that. So let's have a look at the rises over the last month, which were actually quite good. There were quite a number of very significant rises, quite a number over 20%. At the very top, we have the continuing strange situation of JP Morgan emerging MES securities. If you remember, that was the old JP Morgan Russian securities, which has a lot of Russian assets that were written down to zero. And it still owns them. And so there's some hope that it might be able to recoup some value if relations thaw and there's some resolution to the Ukraine crisis. But beneath that, there are quite a lot of rises, which also I think relate to very much the same issue, which is the US election. And the clear result there, I think, has boosted a large number of trusts that have their holdings in the US. You'll see Bailey Gifford US growth there with a rise of 27%, JP Morgan US smaller up 23%, and a number of other trusts where their main holdings are in the US have all been boosted very significantly. So I'll talk about that in a moment. And on the downside, the fallers were not as pronounced, which is quite common. There's one big one at the top, which was Hydrogen One Capital Growth. And that suffered because of the failure of one of its investments called HH2E, which was a German green hydrogen developer. That went bust, and that took out about 11% of assets there. But nevertheless, a very significant reaction to that, which I'll also talk about, because I think the common theme amongst the fallers here, again, a very clear, broad theme, is that renewable energy has really been suffering and has been derated yet again. So I'll talk about that as well. So the US Focus Trust, first of all, I think I'd like to be a bit more sophisticated about it, but actually this was easily the prime driver of what happened to markets. And in a way, it was very simple, that the right-wing candidate won, and that means the potential for lower taxes and less regulation. It was a clear result, which the market had been very worried about. And also, I think perhaps the market hadn't really thought about the positive consequences of that, because I had a lot of manager meetings before this where the subject of the presidential election arose. And I think in all of those meetings, the questioning was all pretty negative. It was all about what might happen if it was a bad result, what the implications of a Trump presidency could be for international trade, how it could upset markets, whether there was scope for any civil unrest, actually, if there was not a clear result. And it was all quite negative. So the fact that there was this very clear result, I think boosted markets very directly and considerably. You can see from the two charts here, we've got the S&P on the left and the NASDAQ on the right. These are 1-month charts, and both of these indices shot up. The S&P by about 5.3%, NASDAQ by a bit more, as you'd expect. So a very significant rally in US assets. And as it happened, I talked about Baillie Gifford US growth last month, which had already made up good ground. And I think that was rather underestimated by the market. It had crept up without people really realizing. Obviously, that's a very tech-heavy portfolio that had benefited, I think, in an outsized way from this rally. And so that's been wonderful news, actually, for anyone invested in Baillie Gifford funds that's been suffering for the last couple of years. But I think it's such an interesting point in the market now. And the question is, after this inflection point, is this rally going to be sustained? Or, in fact, in the cold light of reality, after this knee-jerk reaction, are we going to see the market pull back? Because actually, inevitably, politicians overpromise and underdeliver when it comes to elections. So we'll have to see how these early months of 2025 play out. And I think it's quite interesting. I'm not sure we're going to see a continuation of this rally, particularly as it has driven the US market up to quite a high valuation. And this is something I keep hearing from fund managers over and over again, particularly those who are not invested in the Magnificent Seven and are not really benefiting from this. They point out the high valuations and say, well, it's looking quite risky now. And the counter argument for them is that actually, because so much money has been flowing into the US and into the Magnificent Seven in particular, that means a lot of other markets have been ignored and overlooked and are on lower valuations. So there's a lot of opportunity elsewhere. Just a couple of quick tables. The one on the left actually is from a very good source I have, which gives me the returns of all overseas markets, including all of the small ones. And in the year to date, you can see there's Argentina at the top and a couple of other emerging markets, which is what I would expect. But actually, it's quite telling, I think, that both the NASDAQ and the S&P 500 are on that list of biggest riders. So this has been a very significant rally in the US. It really has stood out amongst all of the big global markets this year. And on the right-hand side, we have a list of price earnings ratios. And obviously, these can be calculated in slightly different ways, so you have to be a bit careful with them. But after New Zealand at the top, you have the US. It's about 26, 27% PE, which is quite rich, I think. Above India, and we've talked quite a lot over recent months about the high valuation of Indian equities, and also Switzerland. And a couple of weeks ago, I was talking to a European fund manager who was talking about his allocation across European markets. And he said the one market he won't have any money in is Switzerland because of the high valuations. And the US is significantly higher. So I think there is a bit of a risk element there. And because of this higher risk, I think you'd have to regard the US as quite a punchy bet at the moment. I don't know whether it's going up or down, but I think you'd have to say it's quite geared. And so you don't really want to have extra gearing on top of that from your US investment trust. I'd be a bit wary of that. So I just had a look at the gearing levels, and actually I can see, and you can have a look in the column here that I've highlighted, the gearing levels are actually pretty low across the sector. And two of the higher ones actually are on Baillie Gifford US Growth and JP Morgan US smaller companies, which were towards the top of that list of risers. But nevertheless, I think the gearing here is quite reassuring because it's not excessive and you're not layering more risk on the risk of the market that's already there. So I'll be watching the US market very closely as 2025 arrives, I think. And on the downside, we had quite a contrast, actually. The other big political event of the month really was, of course, the UK budget, which we'd been keenly waiting for. And I think the outcome was quite disappointing there for the market because the shift in the fiscal rules and the extra government borrowing, I think, did spook the UK gilts market a bit. And this chart here is the UK gilts yield. It's 10-year gilt yield. And you can see, actually, it's hard to see the dates, but this is basically the last month. You can see that gilt yields rose quite sharply actually after the budget, but they have fallen back since. But what is interesting is that that rise in gilt yields, I think, was then expressed and reflected across the investment trust sector, with high yielding investment trusts being hurt by that, and their prices came down, but they haven't recovered as the gilt yield has softened again. So I think potentially there's a little bit of a lag here and an opportunity. And certainly renewable energy investment trusts, I think, are one area where the discounts are really quite astonishingly wide now. Again, they've been highlighted in this table here. And you can see it's a sector-wide phenomenon. This is not because of problems at one or two specific trusts. It's right across the whole spectrum, including the higher quality trusts here. So I think there's a lot of value embedded in this sector. And if you look in the next column as well, the dividend yields are really very enticing here. Clearly, it's very important to look at the sustainability and the prospects for growth there. But you're able to obtain double-digit yields here from some pretty good trusts, I think. So I feel there's quite a lot of value in this sector at the present time. But we've got to, I think, await a change in sentiment, because my strong sense is that investors are extremely skeptical about this sector at the present time. They're very hesitant to invest, and the sentiment is really overwhelmingly negative. And in various meetings I've had in the last month, I've seen this over and over again. And I've got three examples here. The first one is that fall in hydrogen one capital growth, and also Foresight Environmental Infrastructure, which had 2.6% of its assets in this German energy developer. Now, they were both marked down very heavily. To some extent, I can understand it with the Hydrogen One Capital Growth Trust, because it indicated that perhaps the hydrogen market is not developing quite at the pace that everybody had hoped. I think as well, because Hydrogen One Capital Growth was a secondary investor here, it doesn't have the power and the agency of the larger investors, because it was actually Foresight that took the decision to stop funding the developer and let it fail. So I can perhaps understand why the reaction there was quite strong. I'm slightly more puzzled by the fairly big fall in the Foresight's environmental infrastructure price. And I've met the manager subsequently who's talked through this with me. Actually, I feel the reaction's quite considerably overdone there, because that was the only development asset in that portfolio. The dividend is covered. The rest of the portfolio is very conservative. And so I feel, again, the market's probably overreacted to bad news. And the market's not necessarily reacting well to good news either. So on the 29th of November, we saw Harmony Energy Income Trust, which is one of the battery storage developers that's been trying to sell its assets, that provided an update to the market, which was quite positive, actually, saying there's been a lot of interest. They're going to announce, I think, later this month exactly what they're doing there and whether it's some single asset sales or the whole portfolio. But it sounded pretty positive, actually. And again, there's a very wide discount there. So there's good scope for some kind of uplift. I mean, I don't think you're going to get to the NAV, but some kind of uplift is possible. And when this was announced, actually, I noticed that the share price didn't move at all. In fact, I picked up a few more shares myself. And it took several hours, actually, for the price to move. When it did move, it actually went up about 10%. But again, the market wasn't jumping on this news with glee. And the last one, very quickly, SDCL Energy Efficiency, not that well known, actually quite a big trust. This had been sold off very heavily in the last 2 or 3 weeks, actually. It's really come down sharply. And then when it announced its interim results, they were actually, to my mind, very good. The NAV was up slightly. The dividend was completely covered. And again, we saw then a delayed rally on this. But the market's initial stance was that things were bad and it had to be persuaded otherwise. So just to summarize, I think there have been plenty of problems and issues in the renewable energy sector, and those are continuing. So there are reasons for some degree of skepticism, but I think it really does look very enticing at the moment. A well-known phrase that's often dragged out on these occasions is that it's darkest before the dawn. So we'll hope that's the case. With that, I'll hand you back over. Thank you.
Thank you very much indeed, Andrew. I agree with a lot of those sentiments, and yeah, I've got some of those shares as well. Good. Now let's talk to David. Actually, there's just one question there. Let's renewables, ESG.
Yes, I can see the question. Yeah, so I'll answer that actually. I mean, I certainly think that, and I noticed this in investor meetings, that the ESG has slipped down the agenda very considerably, and I don't think it's at the forefront of so many investment decisions now. But I think the shift towards renewable energy is absolutely unstoppable, and there's no way that is moving. And actually, if you look at the government backing for it, that's only rising. So I don't think it's going away, and I think actually this is definitely going to be the primary way our energy is delivered in the future.
I agree with that as well, and especially in the UK. So, as I say, let's now talk to David, please. So, good morning.
Morning, James.
Thank you very much for coming back and doing this again.
That's okay.
As always, though, we're going to assume people don't necessarily know about Henderson High Income. So I'm going to let you talk about the fund a bit first, and then we'll get to some questions, please.
Sure. So if you move to the next slide, and then I think this really kind of sums up the trust. If the name doesn't really give it away as such, it's a trust there to deliver a high level of dividend income to shareholders, but also the prospects of capital growth. And what I say is, we do deliver the income, but we do it in a diversified way. So if you look at the chart on the left-hand side here, yielding 6.6%, that's clearly, a significant premium to the likes of yields you can get into other asset classes, whether that's the UK equity market, whether that's in bond yields, or whether that's in interest rates there as well, clearly delivering a higher premium income to all those other asset classes. But like I said, we do it in a very diversified way. So if you look at the right-hand chart, the orange bars represents the amount of income that the top 20 companies in the FTSE 100 contribute to the overall market income. And as you can see, it's 75%. So the UK market gets a lot of criticism about being overly concentrated for income. And that's very true. What I would say is, even though we're a UK equity trust, or predominantly UK equity trust, we are still a lot more diversified in terms of where we get that income from. And actually, those top 20 companies, they only contribute to around 30% of our overall income. So, high income, diversified way. If you move to the next slide, just a bit of background. And I guess the key element of why we are diversified, and it's what goes back to very much our unique feature, is yes, we're predominantly a UK equity income trust, but the thing that really differentiates us is our ability to own bonds. And that should be seen in the context of the gearing within the trust. And I'll obviously come on to talk about that in a bit more detail as well. I mean, typically our benchmark is 80% equities, 20% bonds. So you can kind of get the idea of how the asset allocation works between the two asset classes there. We are very much bottom-up stock pickers with a keen valuation discipline. Again, I'll go through that in a bit more detail. And we're very, despite being income, it's not just about dividend yield we focus on. We also concentrate on dividend growth. And again, I'll kind of talk about why that's important going forward. It is a well-established trust. We were launched back in 1989, and we've grown to about 375 million of gross assets as well. Next slide, please, James. I talked about the high income. The other thing to mention is probably we don't just offer a high income, we also offer a growing dividend as well. So since I've been involved in the trust back in 2012, we've grown the dividend every year for the last 12 years at a compound average growth rate, a yearly growth rate of around about 2.1% there as well. So, admittedly, it's only modest growth, but given the high starting yield, actually, I think that becomes quite a powerful compounding story going forward, given that 6% plus starting yield and a 2% dividend growth track record going forward. In terms of revenue reserves, so, you know, one of the most important features of an investment trust, certainly for income, you know, we're around about 50% cover in revenue reserves compared to the cost of the dividend today. So again, that should helpfully give comfort to shareholders that the high dividend and the dividend growth that we've delivered in the past can continue going forward, even if we were to go into more difficult times for income generation for UK assets there. Next slide, James. So going to talk about a little bit more detail about the bond element and where we utilize gearing. So another key feature of investment trust, our ability to use borrowings. And that is a really a strong feature of this trust. So where we have long-term fixed rate borrowings, you know, costing us 3.67% in terms of that coupon cost, we invest that money in a broadly stable portfolio of bond assets yielding 5%. So clearly a higher yielding bond portfolio than our cost of borrowings, and therefore that helps generate that extra income for the trust. That's very much a structural element, so that's a permanent element of gearing to help generate that high level of dividend income. Once you strip out that permanent or that gearing that backs the bond portfolio, acts as gearing towards equity, which is kind of the more traditional way of thinking about equity investment trusts. That gearing towards equity is around about 9% at the moment. So much more in line with the AIC UK equity income sector there as well. Now, what is the role of the bond portfolio? As I mentioned, you know, one of the key elements is very much boosting the headline yield, but there are other benefits of it as well. You know, firstly, through diversification, and secondly, through resilience of income. So, you know, if you go into more difficult times, you know, you could clear example is when we went through the COVID period, where 40% of the UK market cut their dividends. Actually, having a bond portfolio where, you know, typically you see bond coupons are, you know, rate higher than dividends. You know, companies are quick to cut dividends. Bond income is a lot harder for them to cut, and it, you know, signals a lot more difficult times. So it's much more resilient in downturns. So it helps provide that certainty of income, even if you go into a bit more of a difficult period for markets and economies there. And the last point, it kind of dampens down the overall volatility. In more, you know, in more stable markets, effectively what you do see in more benign markets, you see bonds are actually typically, especially in downturns, much more stable than, say, equities. So again, you know, having the gearing there backed by a bond portfolio actually helps dampen down the overall volatility. And you can kind of see it on the chart on the right-hand side there, which is just tracking the volatility of the NAV versus the FTSE All-Share. And as you can see, actually, we're pretty close. So even though on a headline level, you look at the gearing at 23%, actually having the balance between utilizing borrowings and investing in bond assets means the actual overall volatility of the NAV hasn't been too dissimilar from the FTSE All-Share there. Next slide, please, James. In terms of stock selection, so what do we look for in companies? I kind of break it down into three key areas, really. So firstly, fundamentals, you know, really understanding the key attributes of a business, what it does, what markets it's in, how it derives its profits, etc. You know, and I think the three key points to me that I focus on is you know, business models, you know, really understanding, you know, do we understand this business model? How robust is it, etc. And effectively, we're looking for businesses that are going to be around in 10 years' time or even more. Then we've got to look at its barriers to entry, you know, high barriers to entry, defendable barriers to entry. So effectively, that business model can be protected from traditional competition or more lately, you know, more sort of new digital companies' entrance into the markets that disrupt an industry. You know, are the businesses we're typically going to invest in, the more mature businesses, are they safe from that new competition as well? Again, it's kind of getting a feel for how sustainable is that business model in the very long term as well. And then the third key point about the fundamental analysis is just understanding who are running the businesses, who are deriving the strategies that are going to deliver the growth that you want as a shareholder. And it's about having that proven management team. You know, I think the last couple of years has kind of shown that, firstly with COVID, how they're going to manage their business through what was a very existential risk to their businesses, but also in the very, very high inflation environment that they suffered as well. You know, how can you manage your cost base to be able to keep driving profits through quite a difficult period as well. Then I move on to the financials of a business, you know, really understanding how sustainable are the returns, how sustainable are the profits, the margins, etc. And ultimately, you know, how well invested a business is as well. So, you know, it's all very well us as income fund managers wanting everything paid out as income. Actually, we don't. We want them to properly invest in their business, not only sustain their business today, but be able to grow those profits in the longer term. Because, you know, a growing profit stream will lead to growing cash flows, will lead to a growing dividend as well. And that's the key for us. You know, again, it goes back to not just a dividend yield, but it's about dividend growth as well. And then the last point in the financials is very much focusing strength of balance sheets. You know, I think that's key for us. You know, no one has got a crystal ball. Can't call markets or economies exactly right or when the turning point will come. But as long as those businesses we invest in have strong balance sheets, actually when times get tougher, when the downturn comes, actually the strength of those balance sheets mean that you're more likely to receive those dividends than not. So that's a sort of key feature for us. And then the third part of the process is very much valuation. And this really underpins the whole process. So it's all very well finding a good business with strong fundamentals and good financials as well. But if it's already in the share price, if it's already, you know, reflecting the valuation, then your capital appreciation over the longer term is quite limited. So it's about finding those right businesses, good fundamentals with what you think are good financials that can improve, but being disciplined on the price and the valuation you pay for it. And I think combining that all together, you know, has delivered, you know, good total returns for the underlying shareholders historically. Move to the next slide, James. So this slide goes into a bit more detail about the importance of not just focusing on dividend yield and focusing on dividend yield and growth at the same time. So the chart on the left-hand side there just shows you actually dividend yield in isolation can be a misleading guide to value. And what it shows you is the black bars show you what dividend yield you thought you were going to get at different levels of dividend yield. And the orange bars show you what you actually earn. So as you can see, the higher the dividend yield, so the further up the right-hand side of this chart you go, actually you don't receive that yield. And that's why for me, we always kind of hunt for equities for companies that pay typically a dividend between the 2 and the 4% dividend yield range, or the 4 and the 6% dividend yields, because historically those dividends have proved to be much more sustainable in the longer term. When you go up to the right-hand side of the chart, what you find is you're in that sort of value trap area of the market where those high dividend yields you thought you were going to get, actually they get cut. And that is quite painful because it not only hits your revenue account, but actually it hurts your capital as well, because generally share prices do go down on a dividend cut. If you look to the chart on the right-hand side, this shows you what your total return historically was or has been in the UK market, broken down by yield buckets. So as you can see, again, it's that 2 to 4% yield range and that 4 to 6% yield range that has produced the best total returns historically in the UK market. Again, because it's that combination of both dividend yield and dividend growth, you know, those are the main contributions to total return. So focusing on that sustainable dividend and companies that can grow that dividend quite healthily, then actually that's produced the best total returns in the UK. So that's why we hunt. I always call it the sweet spot of income investing, is to look for companies within that 2 to 6% yield range as well. And I think that comes back to the whole structure of the trust. So being able to utilize borrowings to invest in a bond portfolio to boost your headline yield, it means within the equity portfolio, I don't have to be too far up the right-hand side of these charts where dividends are unsustainable or where you get lackluster total returns as well. We move on to the next slide. So that was very much a very sort of quick whistle-stop tour of introduction into the trust. In terms of, I guess, market outlook, you know, one of the things that I've been probably saying forever and a day is just how cheap the UK market is. And people have been, quite rightly saying, oh, what's the catalyst? What changes that, etc. The UK has been a dire market for years, etc. What I try and show in this chart is that the UK market hasn't always underperformed. I've looked back at the total returns of the UK market relative to global index, going back in previous decades. And what you find is back in the 70s, 80s, 90s, and early 2000s, is actually the UK market outperformed global indices. So actually the exception has been in that post-GFC, post-global financial crisis period, when interest rates have been zero, the UK market has lagged, and it significantly lagged the global index. So when you look back and analyze, well, what was different back in, again, those 4 other decades, was actually interest rates. So actually interest rates were a lot higher, much more normalized, etc. And that was a period where UK actually outperformed. And it's the exception to the rule. It's really been when we've been living in this zero interest rate environment that's boosted global indices. And let's be honest, it hasn't always been global indices. It's generally been big US tech companies, etc. And that kind of makes sense when your cost of, when your cost of capital is zero, effectively you can go out, valuations don't matter. You can buy most things and actually you'll make a return out of it. It hasn't really mattered. You buy, the popularity in, say, the period in 2021, etc., towards this, zero profitable tech, etc. The price you paid for an asset didn't matter. Now that interest rates are much higher, or historically when we've seen interest rates higher, actually valuations have mattered. The price you pay for an asset when your hurdle rate now on your cost of borrowing is so much higher, actually the valuation, the starting price you pay today is being much more important. And I think you've kind of seen it so far this cycle. So the chart on the right-hand side there just shows you the performance of the FTSE 100 relative to global index. And what we've seen is since the end of 21, when interest rates started going up, actually the UK market has done okay. Hasn't quite beaten the global index, and certainly in the last month, the US market has gone up again. But actually the UK market's been okay. And I think, again, it comes back to the whole point of valuations now matter because interest rates are higher. And if you think interest rates are going to stay higher for longer or more normalized, as I call them, I remember buying in my flat, 15 years ago in London, it was, interest rates were 5% then. Actually, if you think you're going to stay towards that sort of level, actually value as a style probably has a better time of it. And certainly the UK market is definitely a more value market. So I think what's likely to be the catalyst to mean that UK could do well, I think we've kind of had it in terms of higher interest rates as well. If you move to the next slide, James. Won't dwell on this chart, but again, just focusing again, what the chart I've probably shown many a times is just how cheap the UK market is. So, currently on 11 times earnings, as Andrew said earlier, you compare that to, how more highly valued the US market is. It's a very cheap, and yes, US market has a lot of tech, but even if you adjust for that on a sector neutral basis, the UK market is still at a significant discount to the US and other overseas markets, but whether it's Europe, whether it's Japan, etc. We are the, as someone says, a sick man of Europe in terms of that market valuation. But I think that's the opportunity. And certainly if we're not going to recognize the value as investors, certainly there is another area of the market that is. So James, if you go to the next slide. I could talk about M&A activity, again, lots of, bids in the market. Today you've had Aviva, come forward and buy Direct Line, but we've had other takeovers, Britvic, etc. earlier in the year and things like that. One of the other areas of the market we're seeing recognition of that value is just through management teams and the sheer amount of share buybacks you're seeing. So the chart on the left-hand side there just shows you how much of the UK market we've been buying back. And over the last 12 months, the FTSE 100 has bought back 2.4% of its own market cap. Now that compares to the S&P 500 at 1.7% of its market cap over the last 12 months. Now, the US market, S&P 500, traditionally a much more share buyback focused index, very much because of the tax rules over there. UK market, very much dividend focused. We are still dividend focused, But on top of that, we're still buying back more some percentage of market cap than the US market, and actually across, again, sort of the French and the German markets there as well. And what you say is, in terms of that total yield, 3.6% dividend yield, 2.4% buyback yield on top of that, your starting yield as a market is 6%. That's a pretty good starting point. And that kind of, I think, just to get that return is still good. I mean, that's kind of, look at the historic studies over UK equity markets. If you can get 6% over the longer term per annum, that's a good start. That's a good place to be. 6% just from yield, whether it be income and buyback, again, not including any sort of re-rating potential, any sort of dividend growth. Actually, that's a good starting point. And if you look at the chart on the right-hand side, you can see what the power of buybacks are. So I've got a chart here showing the total return of Imperial Brands at the point where interest rates started going up and they started their buyback relative to one of the Magnificent Seven, so Microsoft. Now, you could say I've been selective in terms of time period. Yes, I admit, Microsoft over the very long term has materially outperformed. But I would say is this chart surprises a lot of people. A pretty dull, boring tobacco stock has materially outperformed Microsoft, which has been in this AI boom, has got exposure to this AI boom. In fact, Imperial Brands has outperformed 6 out of the 7 Magnificent Seven over that time period. The only one it hasn't is obviously Nvidia, which is up 300% odd. So I think, you got to put it in perspective and be open about it. What has driven Imperial Brands? It's a share buyback, effectively. Not only the share buyback, they've actually delivered on the profit guidance they've given. In fact, slightly beating it, modest upgrades you've seen. But they've been buying back shares, paying a healthy dividend, and that just has compounded up over the longer term, where you've seen this huge good total return for shareholders, up almost 100%, and the rating has only gone from 6 times to 8 times. So it's still pretty cheap. So that kind of gives you the hint of, those share buybacks, why management teams are deploying them at such a heavy rate, and what it could mean to some of the upside and some of the more sort of traditionally duller stocks that have been particularly unloved in the UK market. If you move on to the next slide. Yeah, it would probably be dismissed of me not to sort of comment a little bit about the budget. It was pretty, from my mind, it was pretty disappointing. I kind of described it as the new government clutching defeat from the jaws of victory. They kind of inherited an economy that was improving, and although they talked about being pro-growth ahead of the election, the budget was anything but. They wanted to avoid tax on the consumer, so they taxed the private sector. Unfortunately, that's probably going to mean corporates are going to look to offset that NI contribution in price rises. They're going to try and offset minimum wage increases through price increases, etc. So effectively, the consumer is going to have to wear it through higher inflation across the high street there. However, what I would say about that is the chart on the left-hand side there just shows you household net borrowings to net savings at the aggregate level in the UK. And what you've seen is, since the GFC period, since global financial crisis, we've been in a very much a deleveraging process across the consumer environment. You saw a massive uptick in that through COVID period, where we saw huge savings. And I think as interest rates have been rising, people have been paying down their mortgages, have been paying off their debt pile to be managing their monthly costs, where you've got to a situation where actually at the aggregate level, consumers' balance sheets are in a pretty healthy state. When you look across to the right-hand chart there, one of the things I think people were worried about post-budget was the immediate impact on bond yields and how the 10-year gilt yield rose to the level we saw in the trust era during the mini-budget. What I would say is if you look at 2-year swap rates, which is basically what mortgage rates are priced off, actually there hasn't been much movement there. So actually within the housing market, actually people can still refinance their mortgages at pretty good levels, round about that sort of 5% mark, maybe slightly less. Actually that's a lower rate than where we've seen at the beginning of this year. So actually, even though the budget's come through, pretty disappointing, it hasn't had that knock-on impact to the housing market, or it shouldn't, given where mortgage rates are likely to settle as well. So what I would frame it is, I don't get me wrong, I don't think it's going to be exactly boom time for the UK economy, anything but I wouldn't get particularly bearish. I kind of feel we're going to be in this sort of sub-trend growth probably for another 12 months. And actually that improving economy we saw, or we have been seeing, I think that just gets pushed out another year. Now, it's quite interesting. A lot of the domestic companies in the FTSE 250 have reacted quite negatively. So the likes of Taylor Wimpey, Genuit, two of the sort of more plays into the housing market that we own, they've fallen, almost 20% in the last month. That's a big move. And actually, they're probably priced in no recovery, whether that's in 12 months or 2 years. So I think actually that's an area of sort of focus we need to be mindful of. And it's not a case of throwing the baby out with the bathwater. You've got to be disciplined on valuation, because ultimately, I think, the UK market is not going to go recession. I think you're just going to see sub-trend growth, where the likes of those businesses can still make okay profits and can still pay an attractive dividend, even in that sort of more subdued environment. Move to the next slide. So where are we seeing opportunities? I've given sort of 3 examples here. The first one is sort of value for money. That's an area of where we focus on retail for quite some time. It's worked really well for us. One of the new additions we've had this year was in Dunelm, so the homeware retailer. What we've seen is they've taken significant market share in that area of the market, even in quite a tough environment, because they offer good quality homeware products, but an attractive price that competition just can't compete on. So, and they've got quality tiering. So whether you're buying a £2 picture frame or whether you're buying a £35 silk pillowcase, that's still at a significant discount to where the competition can charge for the same quality of product there. So we think, in an environment where inflation is probably going to tick higher, consumer probably under a bit more pressure again, actually they can continue to make market share as they see consumers trade down to that value offer there. The second one is within the banks. So again, if inflation ticks higher, interest rates probably stay, or they're probably on a falling path, but not as aggressive as we probably assumed pre the budget. In that environment, interest rates staying high, that's a good environment for the banks, certainly the domestic ones. And also it's been very rational market. So, mortgage margins for the banks have been pretty stable. I think that continues. And what we like about the likes of NatWest, I know it's been really strong this year, but actually it's got what's known as a structural hedge. So they hedge out a lot of the interest rate risk within their balance sheet. So even if you see interest rates come down, they can still grow their profitability as they reinvest that structural hedge at a higher prevailing rate of interest rates. So again, we see that profit growth that we've seen over the last 12 months can continue. And at the moment, they only pay out 40% of their earnings as a dividend because of the government stake. Now, we think in the first half of the year, they will be completely out of that government stake. They're doing a directed buyback, buying out the government of their stake. Actually, if you look at where the payout ratios for the peer group is, it's much more in line with sort of 50-60% payout ratio. So once the government is out, actually, we think that payout ratio can increase. So the dividend growth that we expect should accelerate as that payout ratio increases more in line with the wider peer group there as well. And then the third one is kind of a turnaround situation. So, the outlook for the UK economy, again, is a bit more clouded. The outlook for the global economy, again, we don't know what Trump's going to do in terms of tariffs, so we need to be mindful of that. So what we're trying to find is very much, those turnaround situations that can generate profit growth, value realization without too much reliance on the global economy. And I think Reckitt Benckiser kind of fits into that. It's one that's been pretty poor share over the last 5 years or so. In terms of the actual underlying organic growth it's been delivered, it's got litigation risk in the US and stuff like that. What I like about it is actually, I think that litigation risk has been de-risked, shall we say. They won the most recent case in St. Louis, and certainly I think the worst case scenario is overly discounted in the valuation now. They are selling off some of their lower performing assets. Again, I think there are buyers for those assets. I think they get a good price for that. And actually the rest of the business, what they're going to focus on is in good categories. It's actually growing organic growth well. They've got very good, strong brands and good market leading positions. And actually, if you see disposing of those assets, you see the margin, the cost savings plan coming through, you see higher growth business, it deserves a significant re-rating on the back of that. So, it's one we like, which we think is particularly undervalued right here, right now. Last slide for me, I probably won't go through it in too much detail, just shows you where we're positioned in terms of some of that sector exposure, where our top 10 is. What I would say it's probably a good mix between some of the sort of stable, higher yielding areas of the market, but also some of the names we have that offer a bit more growth into the portfolio. So the likes of the 3Is of this world, RELX, Unilever to a certain degree, offering a bit more growth versus, some of the sort of high yielding names, whether that be some of the tobacco names, oil, or utility space there. But I'll leave it there, but happy to obviously answer anyone's questions that may have come through.
Brilliant. Thank you very much, David. A few questions about the bond portfolio, if you don't mind. So can you sort of tell us what the yield is on that and how that compares to the yield on the equity portfolio, please? And also, what sort of bonds do you hold and what sort of geographic spread of them?
Yeah, so the bond portfolio probably yields about 5% at the moment. The geographical split would be half UK, half US dollar bonds. Again, I think we have the facility to go up to 30% overseas within the trust, and the bond team like to use that within the bond portfolio because actually there's deeper pools of capital in the bond markets within the US bond market there, so they use that. In terms of kind of the ratings of the bonds, typically where we've been is a third is government bonds, third is investment grade, and a third is sort of high yield. So a real blend of sort of quality. We're probably shorter duration than the benchmark at the moment, which is actually, in a world where we've seen bond yields rise, actually the bond portfolio has been a lot more resilient than the benchmark. So they did a good outperformance against their own specific bond benchmark there. So hopefully that gives you a feel for the overall bond portfolio.
And then I think you mentioned, so you can invest overseas.
Yeah.
To what extent do you use that, and when do what do you use it for?
Yeah, sure. So within the equity portfolio, I think we do it effectively. There's a couple of reasons why you would do that. The UK market can be quite concentrated within certain sectors. So the classic example is within pharmaceuticals. So we've only really got two pharmaceutical companies in the UK, AstraZeneca, Glaxo. So actually I own both of those, but I also own Sanofi as well, the French pharmaceutical company. It gives you a way of increasing your overall exposure within a sector, but not necessarily being too concentrated to two stocks in the UK. The other reason we would go overseas is to try and find exposure to certain themes that are underrepresented in the UK market. So we own Texas Instruments, which is a semiconductor listed in the US. Again, there's no real exposure to semiconductors, which is pretty much a long-term structural growth industry. So we've gone into the US market to get exposure through Texas Instruments. So those are the two main areas you would do it. There's also just single stock examples where you're happy to go overseas to own something. So we've recently bought something like Sodexo, which is a French contract caterer. Again, I think there's a good turnaround story in that business, which again that's the kind of stock specific where I'm happy to go overseas. I sit amongst the global equity income team at Janus Henderson, so we've got a wealth of experience of looking at some of those overseas opportunities there within the house and within the team.
We've talked a bit about sort of bond yields moving around and interest rate expectations moving around. What's your attitude to things like utilities in this environment? I know you've got 6% there. And there was a specific question about would you be tempted by any of those yields on the renewable energy funds and the infrastructure funds in the closed-end space?
Yeah, so if I answer the latter part first. So we can own a few of the alternative investment trusts, and we do. The two we own at the moment is Greencoat UK Wind. So trading at 20% discount, 8% dividend yield. The underlying cash flows are backed by a lot of it. 60% is backed by government subsidies. So it's pretty well covered that dividend. And it's a big trust. It's liquid. It is probably, I think, the one that's got the longest track record. So And I've met the management team, you know, many a time. So, you know, they're pretty sensible guys as well. So I feel pretty relaxed about that one. Some of the newer ones, you know, I don't know too well. You just wonder whether the yield is kind of the tail wagging the dog, where certainly with Greencoat, the way it was set up, it was the other way around. It was, you know, what the cash flows are and that's supporting that dividend. You don't know whether the dividend was a starting point to get to that. The other one we own, we quite like, actually, not in renewables, but investment trust, is Tufton Oceanic Assets. So shipping assets, you know, they've done really well to grow their NAV. Again, it's investment trust for some reason trading at quite a big discount, big dividend yield, really well covered by cash flows. Again, really strong management team that's proved over the longer term. So again, that's one we like. In terms of I guess the listed utility space in the UK, you know, I pretty like, you know, we talked about, you know, the long-term energy transition in the UK, you know, the likes of SSE, the likes of National Grid. You know, National Grid are investing a lot in terms of the infrastructure that you need to be able to connect a lot of those wind farms, solar farms, etc., into the grid. So like that, given the returns you're likely to see on that investment is, well, it's regulated. We know what the returns are like. It's about being able to deploy that capital in a cost-effective way. So we like National Grid. We also like SSE. Again, it's got the infrastructure, but it's also got they're actually one of the developers of the wind farms, etc. And I like the business because it is having those two together. It means you can actually allocate capital between them depending on where you're seeing the best returns at the moment. Again, I like that. You know, the shares are pretty inexpensive as well, and they pay a good growing dividend yield.
That's great, thank you. I think we've probably run out of time, but thanks very much for your time today.
That's okay, pleasure.
Really good. There's some performance numbers there, which we have to put up, and then some disclaimers. Just on terms of the dividend outlook, I know that's something that's more in the board's control than yours, but is the ambition to grow it ahead of inflation over time, or is that something that it's harder when you're on a very high yield to start off with?
Yes, it would be harder for a trust like us, given the high starting point, to sort of grow in line with inflation. I suppose if you look at the history of what we've done over the last 12 years, you know, around about that 2% level, which I guess is kind of, think about CPI and what the target rate is of the Bank of England, we've kind of done that. So you would hopefully be able to maybe sustain that in the longer term. It's not a stated goal or anything like that, but I think that's a track record that I think has served the trust well. So hopefully it can continue.
Brilliant. Thank you very much indeed for today.
My pleasure.
Good luck with it all, and we'll talk to you again soon.
Thank you very much.
So we're back next week talking to Craig Baker from Alliance Rattan about the merger and what happened to the portfolio since that happened. And then we've got a break for Christmas, and Andrew and I will be back at the beginning of January talking about the whole of 2024 in a sort of great sort of mammoth roundup. So have a good weekend, and we'll see you again next Friday. Thank you.